Okay, good. Alright, today's plan. We're going to go through some further metrics that we touched on yesterday with regards to market profile, but didn't get time to fully investigate. So we're going to do that. Then we're going to talk about day types that are recognisable and come from our market profile again. And then later on today we will be going through, it's a slight shift in and a slight change in what we would normally do today because it is month end. So of course you've come in and asked about it already. So I have prepped to do a couple of bits and pieces on your sort of monthly diary, the figures and the data that's out, in preparation for next week when we're going to go through it all in detail. And then we are also going to talk about month end. And contrary to popular opinion, there is actually a reason why it happens. And yes, it was talked to you about 12 weeks ago. But thanks for caring. There is also a video on. It's an older video when I particularly chastised a large group of our traders for trading month end incorrectly. I'm not sure if you guys behind have actually seen this video, but when it plays out, you might want to watch it. So we have got quite a lot to get through. It is of course also a Friday, and I do have a headache, so I'm going to try and shift that first. Was there any, before we crack on, was there any particular questions or anything from yesterday's market profile, or was it just quite a lot to take in?
Yesterday,
Yes.
showed us the price numbers and
Yes.
different prices
Yes.
for each of them. I just didn't really understand what the figure means and what's one tick actually in real value.
Right, this goes back to when we were talking about the contract specifications. The price that you're seeing is the price that that product is actually trading at. That is the price. And it obviously moves up and down throughout the day. So for every price increment that it moves, that's what's called a tick. And the value of it changes depending on what product. But for example, and it goes back to, do you remember we were talking about the notional value of the government bond and like some of the currency futures, what the underlying value is. It's all based on that. So traditionally a euro, a tick in the Bund would be worth 10 euros. So if you make a tick, if you buy the product on your price ladder at the price of 166.17 and you sell it at 166.18, you'd have made one tick. And that tick is worth 10 euros.
How did you calculate that out?
Sorry?
How did you calculate to 10 euros?
Right. Do you remember when we went back to...
Day 3, I think.
Yeah, in here. So if you get these slides and you go back through these. Okay, so here, do you remember we were talking about the nominal value or the notional value of the product? And so for example, let's do an easy one like the euro. The trading unit, the nominal value or the notional value of the underlying product is $125,000.
So you have to work
Okay.
table to work out.
So when you look at the price of it, because it's priced in 0.0001 of a euro cent, you then divide what it's priced in so your 0.001 of a euro cent into the trading unit, the nominal value of the underlying product, and in that case it would give you $12.50 per price movement per tick. And so it's all on this slide, it's all set out. They're all different. I mean, it tells you here, so soybean oil is $6 per contract. But the reason it's $6 per contract is because you're trading in dollars per pound. A unit is 60,000 pounds. So your actual underlying, if you were trading soybean oil, your actual underlying that you're trading is done in units of 60,000 pounds worth, weighted pounds of soybean oil. And the way that the future is priced in 0.0001 again of a contract. So it's this divided by this, and it gives you $6 per contract. So the tick value in the tick size is always your trading unit divided by your tick size. And each tick size that it moves, if you buy it and you make one tick, you will make a contract's profit. And it will either be, you know...
So we always need to go back to see the table to work out.
You'll just remember it eventually.
Yeah.
Eventually you'll just remember it. I mean, it's... At the beginning, yeah, you'll say, well, how much is a gilt worth? And I'll know off the top of my head it's worth 10 quid. A treasury note, a 10-year treasury, I know is worth $31.25. You'll just muscle memory, unless you're Richard, and then you just forget everything. But that's how it is. It's basically the value of the underlying divided by the tick size that it's trading in. And when you see it on the price ladder, and you see it moving up and down, that is your opportunity to make ticks or lose ticks, and they all have value. And that's what you saw yesterday on the price ladder. Yeah? Good. It's handy having all of these arranged in order. How are our VTFTs doing? Any questions from them? No, nothing. They're all good at the moment. They all seem happy. Alright. Let me just neck my paracetamol. Right, okay, paracetamol necked. Okay, everyone's doing good. Right, let's go through some more of these key metrics. And we'll go through these. This is really where we left off yesterday. We were talking about the key metrics within our market profile. We were talking about our initial balances, our opens, our closes. Well, there's a few that we didn't get to go through yesterday. HVNs stands for high volume nodes. You should expect from a high volume node a gravitational pull back to these areas as high volume is traded here. It is not often used as support and resistance, primarily because the concept of a high volume node is that it should trade volume there. So the market should churn at a high volume node, it should do a lot of business at a high volume node, and therefore you wouldn't necessarily want to get involved there because it's not an immediate point of support and resistance. However, and we'll go through a lot of real examples on the charts, on some occasions when there is a particular high volume node that we've moved a long way from and we're coming back to it, it can act as support and resistance. So there's a little bit of a a sort of double-edged sword there, and we'll go through we'll go through some charts and look at various bits and pieces as to when it is a usable support and resistance and when it isn't. Low volume nodes, however, remain areas of low trading. Therefore, they do tend to act as key areas of support or resistance or turning points in the market. So very often I will talk about low volume nodes as being our line in the sand, the point at which the market is going and moving from bullish to bearish or from bearish to bullish. Low volume nodes over a long period of time stay low volume nodes. However, and again this is part of the art of it, when you combine market profile charts over a long enough time horizon, all of the markets would be a perfect bell curve over a long time horizon. That is what the market would be. As you draw that time horizon a bit bigger, you will generally find that low volume nodes can become the next day's high volume node as the market fills the area in. So again, we need to assess when a low volume node is going to actually be support and resistance and when a low volume node needs filling in. NVPOCs, naked volume point of controls. I tend to call them naked VPOCs. It's a volume point of control that has gone untraded in the next subsequent day and therefore remains untouched the day after. It becomes naked. It acts as a significant point of support or resistance. Closing gaps are closes in the market that have gone untraded in subsequent days. And closing gaps also act as significant support and resistance. The longer that the closing gap has been within the market, the stronger the resistance becomes, even though it hasn't actually traded there. So, 4 quite simple concepts, but we're going to go through them in real-time charts as well as our charts that we've got here. So these are part of our key metrics. I'm just going to widen it up a bit, so I'll drop off the screen so that you guys can see it. So you can see 3 things that I've marked out here. This area here, tucked in by this red arrow, is shown up and highlighted within the profile as a low volume node. Now the reason we mark low volume nodes within the profile, of course, is because we expect at tails, buying or selling tails, you expect lower volume. However, in the middle of your profile or in any other area of the profile, you don't actually expect to see a low volume node. So what it means is that at this price point, something significant changed. It could have been over a fundamental announcement. It could have been a pinch point for buyers and sellers. It could have been a new order that comes into the market. But we don't expect to see these unless they're at the extremes. So as per standard bell curve theory, you expect lower volume on your tails and then the volume sweeping into the middle. Well, if it marks itself as a low volume node within the middle of the profile, it's a significant turning point. You do also tend to see these around single prints. So you'll see here there's a significant set of single prints. It's also marked with a low volume node tucked in here. It's also, if you notice, our volume value area low. Therefore, that price of 75, and you guys were in the room when we were talking about this same price, so this is only a few days ago, that price of 75 became highly significant. And you can see the next day, that is where we posted our low of the day, because the price point started as an LVN, was also single prints, but was also the tail of our volume value area. So we always look to mark out where the low volume nodes reside within the market. They act more as support and resistance. Now if you look across at the high volume node, now the high volume node can be different to the VPOC. Sometimes it is the VPOC. Okay, so the volume point of control is your highest volume that has gone through on the day. So of course it is going to be a high volume node. However, you should always look to pinpoint where your secondary or tertiary high volume nodes are within the trading day. And of course you can see on this day there was two quite significant high volume nodes at the top end of our profile. It also coincided with our TPO value area high, our initial balance high, and also our value area high. So was it really a surprise that the next day it was our high of the day? It posed significant resistance because on that day it wasn't just a high volume node, but it was a high volume node at key areas within the market. So you should always be looking to pinpoint your secondary and tertiary high volume nodes. Now as we go through, you'll look to find these in other chart patterns and other chart formations as well. But again, just sticking to profile for now, you would also look to find high volume and low volume nodes on a weekly and a monthly time frame. As you congest all of your market profiles together, you would again be looking for the pinch points and the turning points that are within the market. And these are the points that you wouldn't find on a candlestick chart or in any other form of chart other than using a volume profile type situation. The other thing to point out, just to re-emphasize, our naked VPOC runs along here. It's this big red line that has kept on running and running and running. Fortunately, a lot of chart packages nowadays put these in for you and run them until such time as the market comes back and breaches them. It also does the same, as you notice, for single prints. It didn't breach them on this day, so it ran them through to this day to tell you, that there's still exposed points within the market. So this naked VPOC is from this day here. The high volume node stands out, and until such time as this market trades back down there, that red line will just continue and continue and continue. In this situation, because we've moved away from this area significantly for quite a long time now, 5 or 6 days, this would act as major support as we drift, if we drift back down there. Combined with the fact that you can see it is also your high TPO count and it is also your initial balance high, you would be expecting a significant amount of buys to sit down at that naked VPOC. Naked VPOCs are usually significant areas of support and resistance in the short term before they revert back to trading high volume there. The other thing to keep an eye on are closing gaps. You can see I've highlighted it with the red arrow.
Reminder, next data is up in 9 minutes.
This again is very recent. The market has closed here. We have opened higher on this day, and as the market has tried to push lower, it hasn't tagged the previous closing price, and so it's left what's called a closing gap. It's different to a pure gap in the market. A pure gap in the market is where the low of
You
the
also
next
see
day
Italian
is
CPI
above
data.
the previous
The
day's
year-on-year
high,
is expected at
or the high of the
0.1%.
next day is above the previous day's low. So it's different to a pure gap. This is a closing gap. It would also act as a significant area of support so long as we've left it for a couple of days or so. The figures on this are roughly, for something like the Eurostoxx, for example, it trades the previous day's close about 82% of the time. So you don't often see closing gaps in the Eurostoxx. One of the key statistics, if you're looking to position yourself to, find some short-term market direction, one of the statistics that people use is that 82% of the time the Eurostoxx will tag its close. So when it doesn't, that's fairly significant, but it will only happen one every 5 or so times. The Bund statistics are probably not too dissimilar. So, going through these key metrics again and looking at actually some of our purer charts and actually how we would interpret this more throughout the actual day rather than in pictures. This was the picture that we showed you at the minute of our Bund. So you recognise when you were looking at the actual images on the slideshow, this is very, very clearly where they've come from. So at the minute you can see this is what we saw the other day, our close, our single prints. This naked VPOC is still running. It's still underneath the market. It's still sat there. Of course, from yesterday, now what happened is late yesterday, there was more news about Deutsche Bank. And the markets reacted incredibly negatively in terms of the S&P and the Eurostoxx. The Eurostoxx absolutely collapsed because there was a sources story that came out saying that some hedge funds were moving away from Deutsche Bank and were protecting themselves against Deutsche Bank going under. So of course the markets reacted aggressively. The Bunds, as a safe haven and a flight to quality, opened significantly higher today, and you can see that what's been left is we have a closing gap here down to 91, and we also have a VPOC that runs underneath that we have moved away from at 71. So this is currently today our naked VPOC, and this is our closing gap. Both of these areas on a return to will act as significant support. The closing gap down at 91, I would imagine if we do get down there, we'll get a bounce from there. And of course this high volume node from yesterday, where we've also got the initial balance low and our TPO, so that's currently running in the market. Now sometimes what I want to try and find are some real examples going back in the Bund as to when these have actually worked quite nicely. So we're just going to spend a little bit of time scrolling through and looking for some key areas that have been significant price points where the market has reacted well to. Sometimes it's quite hard to find some of these bits and pieces because it obviously disappears off your chart. Okay, so here's an area where very, very first out the gate, our closing gap, so we opened only by a few ticks lower, but our closing gap acted as immediate resistance. Straight away, straight off the bat, immediate resistance at our closing gap. And when we start talking about day types, you can see this actually then from that resistance turned into a trend day lower, and the market just continued to move lower. other days where you'll see these sort of things work. Need one where it's moved away quite significantly. Okay, so here
PPI is reported at -4% year on
you can see we've opened with a very small gap. I might just put a split in there. This is where we've come in. The market's gapped lower at 53. We've come up to the closing gap of 58. Traded a tick through it, but then we have backed off and come back down here, back to our value area. So this day here, although it didn't stay resistance because we traded through it later in the day, very initially, very first thing, the market used the closing gap and acted as a significant area of resistance. Looking at a day like this, this is where our low volume nodes can end up being significant resistance as well. You can see that we were balanced for a lot of the day. On this day we spent an awful lot of time just trading in a very tight range, and then late in the afternoon the market broke lower. Again, possibly some significant news late in the trading day, but you can see that we left single prints. We left a big low volume area here. We left a big low volume area here, and we closed pretty much down on our backside on our extreme low of the day, which is where we opened up. And you can see that on a push back into this area, we used this big low volume area as our significant area of resistance that day. Some further examples, you can find some. Okay, just tucked in here. If I split this up here. So again, this is what we were looking at. We had a bit of a closing gap. So the close on this day here was at 56. We opened at 68, so we had a 12 tick price gap. As we pushed lower on the L prints, we didn't quite get down there. On the M prints, we got down there. We saw it a couple of ticks. We had to wear it offside just a bit, but it acted as support, and then the market balanced back away from there. So closing gaps are very, very important. The longer that they are left, the better. But they are very, very key areas of support and resistance. Now, in terms of some of our naked VPOGs and whatnot, I'm not sure if we've had any.
The core 0.8, Blade expected 0.9, unemployment 10.1%, Blade expected 10.0, Italian CPI is harmonised and headline year on year, both at 0.1%, both in line.
Okay, here's one.
So Eurozone CPI estimates in line at 0.4, the core at 10 below at 0.8, unemployment 10.1.
So this day here, we've had a naked VPOG for quite some time. Scrolling back, and we can't even find where it comes from 162.66. So 162.66 was still there. Wow. Okay. It's a biggie.
How far have you gone back there, Dan?
We're now back into June.
7.5 billion of 26s, 31s.
And we still can't find the bad boy.
So again, that's 10 year,
Getting close.
15 year, and then 50-year issuance from France next week.
Okay, it's from this day here. Wow. So this is from the 16th of June, where we've had this VPOC that has been here for quite some time. The market actually traded lower, and actually spent a fair bit of time trading a lot lower. And I'll tell you what happened is we ended up with Brexit Day, and of course we priced ourselves significantly higher. over the course of Brexit Day. Now, even on what was a terrifying day, this naked VPOC remained untouched. So it actually didn't even get close to it. Didn't really act as any major support or resistance. And then a few days later, you can see we got down a few ticks higher. So we got down to 162.70, and this was about 13 days after the initial VPOC was created. The market went back down there and it acted as support, acted as significant support. We've actually been down there since again, and the market has continually rejected this area over the course of the, well, still ongoing. The market is still not touching this area, and it still remains to today a VPOC and is still running and running and running, and obviously resides off the back of our charts all the way lower. So I mean, naked VPOCs, it's quite hard to sort of, because once they get traded through, it's quite hard to see them. I wonder if the Eurostoxx has got any better examples. So today there is a naked VPOC that's running all the way down at 29.06. It comes from quite some time back. So that VPOC from 29.06 was created, blimey, ages ago. There it is, created on this strong day here. So not only on this day did we have an incredibly strong naked VPOC, we also had a very, very high TPO count that came in at 29.08. The market opened a little bit higher. It tried to push onto it first thing in the morning. It couldn't. It actually held its very small closing gap. And then the market accelerated away, and it left that naked VPOC at 29.06. Now, quite some days later, and it was a long time later, where is it? On this day back here, Friday the 16th of September, the market came back down to this area, and you can see it held at 29.08, just a couple of ticks above this naked VPOC, and then the market shifted back significantly away from it. And this morning it has done the same thing. It has come down, it's challenged this area again at 29.09, just a handful of ticks above 29.06, and the market has accelerated away from it again. Currently to the upside, okay, we had a naked VPOC on this day that came in at 30.20, created on this Friday across here. Very quiet day, but created this VPOC, and then 4 days later the market came up. This time it went through it, only by a couple of ticks, but it acted as significant enough resistance, and the market then backed away very, very significantly. That was actually yesterday that the market did that, came up, tagged that naked VPOC, and then ran lower. Of course, here on a day like this, it acted as resistance straight away. The market just opened at its VPOC and just drove lower. Key areas of single prints and low volume nodes, again, just as a reminder, as we're on the chart, we have one here, and you can see that we broke up higher on this day. We left our single prints, We left our low volume node. Again, it did it at an area where it's done it before. So it shouldn't be a surprise. Like I say, low volume nodes remain areas of low trading. Therefore, they tend to act as key areas of support or resistance or significant turning points in the market. And on this day, it's done it before. It's acted as a significant area before. We've come up to it. You can see that we've held it on the O prints. So we've held it as resistance to start with, and we've backed off a few ticks, but we couldn't get back into our initial balance again when we were talking about the significance of our initial balance and using that first hour to dictate and decide what day type we're likely to embark on. We couldn't get back into initial balance, and the markets then accelerated higher and used this as a trigger point, as a key area of turning, and has accelerated to the upside. Of course, when we've come here a few days later and the market has actually gapped lower, this was the beginning of this week on the back of those Deutsche Bank stories, so the market was prepped to be lower. As we've pushed up, we've pushed back up into these single prints, we've used them as resistance, and then the market has accelerated to the downside. Yes?
Have you explained what this pink line means? The pink line goes through Q?
The pink line is where the market has only left one time price opportunity, so one TPO. So it's the market has, you can see it's only done one time print there, and these are what are called single prints. Okay, so the pink line signifies where the single prints began. Where did the market start to turn? Where did the market accelerate? Okay, so it's not going to post them in the middle. It's not going to post them at the top because we moved upwards. It always posts them where the move began. So in terms of it being a downward move, so that's fine. It would,
How many single prints would a pink line?
sorry?
How many single prints did we need to become like a accelerator?
Just one. Just one. I mean, here's, for example, there's two. Here there's two. Here there's two. So again, it's posted the pink line because this is a down day. The market's moving lower. It posts the pink line, and it doesn't have to be pink. You can change it. It posts your single print line at the extreme of the move, where the move began. Okay, so it posts it where was the acceleration point. So on a downtrend, it will always be at the top of your single prints. On an uptrend, it will always be at the bottom of your single prints. I'm sure there are numerous examples where we've only posted one single set of single prints. There you go, there's one there. So these are single prints on this day here, but it was actually only one TPO that was left. One time price opportunity. So high volume nodes, low volume nodes, naked VPOCs, closing gaps, and of course with the low volume nodes you tend to see that have single prints as well. They don't always have to have single prints, but they usually do. So on a day like this, this hasn't got any single prints, but it's got a very, very significant low volume node.
Sorry, which one are you looking at then?
In here.
Oh.
So on this day here, it's got a very significant low volume node. It doesn't have single prints. It's effectively what we'll go on to describe as a double distribution day. But the next day, if you look at your initial balance here, the market used this low volume node as resistance. So the market's opened it's come into this low volume node, and then the market has moved back lower. So low volume nodes don't always have to be where the single prints are. So example here, there's a low volume node here, but our single prints are lower, and actually on the single prints it's actually got a fair amount of volume. You know, this is okay volume that's gone through here, whereas up here this is very, very low volume. So this is where I would mark as a significant area of support or resistance. Yes?
So what's the peak acceleration line supposed to be telling you?
What's the...
You know the peak line?
Yeah.
They tell you the acceleration. But like, what does that mean, like, unfortunately?
It means that's where the market made a key decision point. So that's where the market has said something's changed. It could be a figure, it could be technical, it could be a speaker, it could be, I mean, very often, you know, for example here, it's because we've made a new low. So it will always become an area of support or resistance, a turning point in the market. It gives you the understanding and the knowledge and the ability to think that there is a trading opportunity coming up. This area should act as key resistance or key support. So on a day like this is probably why it didn't even get close, because you've probably got a lot of locals being you, me, looking to sell into this area. So they've probably got all of their offers stacked up here. Nobody's willing to buy. Everybody knows that the market's coming to a big area of resistance, and so of course the market fails a bit, you know, a few ticks away from it. So that's where your skills as a trader need to determine, okay, I understand this is an area of support or resistance, so what do? Do I wait to see if I can get my price point exactly, or do I actually enter the market a little bit lower because I can see that the market's not actually even getting to my key area of support or resistance? So whenever you're looking at any of these metrics, you're always looking to use them as an area to enter a trade. These are key areas of support, key areas of resistance, and we're always looking to see and find those areas that are going to give us a high probability of success, an area of good support, an area of good resistance. So if we scroll back through and we look at yesterday, for example, the pink line is telling us that if the market moves back up here, I categorically want to be trying to sell up here. This is an area that I want to be a seller at. If we do, I have got orders in the market to sell at these levels, because if the market pushes up here, not only can I see that this is where we accelerated from yesterday, this is where the market made a key decision to push lower, change value, the perception of value shifted here. So prior to this move, we had incredibly significantly decided that value was here. So if we look at this high volume node, it is so significantly bigger. It's almost twice the volume of any other price point on this trading day. So value was accepted here. Buyers and sellers agreed in terms of volume for the majority of the day that value was set at 29.80. It was at 29.70 that the people that had accepted value was higher have decided value doesn't sit there anymore. Something's changed, i.e. Deutsche Bank fell out of bed. Okay, Deutsche Bank, listed on the US exchange, collapsed. And so the people, that was their decision point, that was their turning point, that was when the market, at this point, this price point, shifted. And so what it tells me is that a move back to this area it should actually be quite stretched. The market should actually be quite stretched by the time we get up here, because value is no longer up there. And the closer and closer we get to shifting away from what is actually today's value, I want to be a seller, because I don't think that the market should have the same value area as yesterday, because something has changed. Now, not only that, but whilst we're here, what is also important about this area is how significantly it's been used over a lot of days. So we've not just got yesterday's single prints, but actually this area, let's look back. This area was a value area high on the 26th of September. So across here to this day, it was a value area high. It was also a close. On this day, it was also where the market triggered higher. So on this day, we opened here at the K prints, we opened at 63, and we hit our closing gap up here. We traded here, and it was at that point that the market's gone, okay, we're shifting higher. So 70s on this day was a key decision point for an up move. Yesterday, it was a key decision point for our down move. So this price point is telling me that this is an important price point. This is a pivot point. This is a point that the market has actually used, not just yesterday, but we've used it Monday, Tuesday, Wednesday, and yesterday. So if we come back up here, I've now got not just one reason to sell it, I've got about half a dozen reasons to sell it. And they are all very, very strong. If you look at yesterday, it was also, give or take a couple of ticks, our volume value area low. Okay, so again, part of market profile theory is that these value areas shift. And what becomes an area of resistance turns into support. No more can you see it than on this day here. This was our value area high all day. So the market had sold significantly lower on the day, and our volume value area high was at 62. Now the market did shift higher and started to get out of value, which means one of two things. It's either going to shift back into value, or it's going to move and find a new value area. Remember what we said yesterday, market profile theory, it was one of the key summary points. Markets, let's find it because it says it so well. Day 4, patterns of behaviour. Markets seek balance. They seek to find an acceptance of balance. When a market is out of balance, it auctions away from its previous point of control to find new accepted value. Markets shift. So markets, they have found value down here. This is its value area. Its volume value area is here. As it shifts out of value, especially if it closes out of value, which it did on this day here. So it's closed out of value, out of volume value. It's an indication that the market is going to try and find new value. And of course, in that instance and that situation, the value area highs, the value area lows represent areas of support and resistance. And it happened beautifully on this day. We had a day where we had accepted value, we shifted out of value, we closed out of value. Therefore, the next day, the value area high was significant support. Had the market have come back into value and closed back in value, there is another principle that says we will drift back to yesterday's full value. So it really is, when you wind trading down, you're winding it down to actually one of two things. Is previous value accepted, or is the market shifting out of value? They are the only two things you should ever be thinking. Is previous value accepted, or are we shifting? Of course, yesterday is another classic day where we have closed extremely out of value. Extremely out of value. So of course, closing out of value meant that the previous day's value area low will be and should be an incredible area of resistance. So look at this day here, because this happened on this day again. On this day here, we had value posted between the price of 77 and 92. That was our accepted volume value area range. Note how I'm putting a lot more emphasis on the volume here. Specifically, I always do. This was our accepted volume value area. We pushed up late and we closed out of value. We opened even further out of value. Okay, so the market opened out of yesterday's value. Note what happened at this point in the day. The previous day's value area high acted as incredible support. This is not coincidence. This is fact. This is how markets behave. Okay, yes, of course, later in the day we moved through it. We decided that this was no longer value. We thought it was. We thought that we'd shifted value. So this is great that this day you're trading away and you've shifted value higher on this day. Okay, so this is this week. Okay, if you were trading live, these were trades that you could take this week. We've had value down here, we've shifted out. Incredible support. We've seen it on this day, worked beautifully. Shifted value higher, closed out. Opened out of value, same pattern of behaviour. We have accepted that we're shifting out of value, and this value area high, much like it did on the previous day, became an area of support. And value was shifting higher. What changed was the afternoon session. Deutsche Bank changed. We came back into value. Look where we shifted value back to. Okay, I'm sorry it's not tick perfect. I wish it were tick perfect, but it wasn't. But we shifted value straight back to where accepted value was the day before. So no longer was this value. This was now value, back down here. But then the market's gone one step further. As Deutsche Bank collapsed 7%, they've gone, actually, this is dangerous now. Value's even lower. Okay, so the market seeks to find value. Value shifts about. People's perception of value changes dependent on what's going on around them, dependent on news, dependent on supply, demand. Markets shift value. They seek to find value. They accept it. Things change. They seek to find new value. It gets accepted. When value doesn't get accepted, it needs to go and find it elsewhere. It's going to be up or down.
Is that the V part, the red line?
Yes, this was our volume point of control, yes. Yeah, so what's happened is, because I've split the chart up, so this is now yesterday morning's session, and this is when Deutsche Bank hit the wires. So what had happened is that the volume point of control had shifted higher, up to 14, but as Deutsche Bank came out, it's then shifted back down. Okay, so there are, when we start looking at other charts, we start putting in shifting VPOCs, and you can actually see where the volume point of control shifts throughout the day. So you can actually plot it so that it trails throughout the day, and you can see where markets are moving. So where during the day VPOCs will change, so it might be from 10 and then it will shift VPOC up to 20 and then it will be back down to 10. Well, that tells you a story of itself. 20 was too high, they didn't like value at 20, they want it back at 10. So your next question is 10 still accepted value, or are we going to shift it lower? It's unlikely to shift higher because we've already been higher and rejected it. So again, you're bringing your options down. You really, really do. When you put trading into context, you really only ever have 3 options. You're going to shift up, you're going to shift down, or you're going to stay the same. And this is how you assess statistically what is a higher probability of happening. Not a guarantee, just a higher probability. Okay.
And what's the light blue line?
Sorry?
The light blue line.
This.
Yeah.
This. Okay, I haven't gone into this yet. It's a bit suspect as to how often it works, but this light blue line is your initial balance extension. Okay, so I haven't actually gone into this yet, but what it means is that this is your initial balance extended by 50%.
Why?
Why? The market the market goes through cycles of things working and things not working. I think when these guys were on the scene, going back maybe a couple of months, 2.5 months, there was a time when, for no reason whatsoever, the Eurostoxx used to extend its initial balance by 50% and then use it as support and resistance and then move the opposite direction. It hasn't happened for quite a long time because we've entered a new cycle of the Eurostoxx being particularly aggressive at the cash open. However, I do leave it on there because one day, maybe at some point, it will become of use again. But for the last few, I mean, it's more coincidence than anything, it kind of used it there, but you can see it's just blown straight through it there. It's gone straight through it here. It's just something that I keep up. I mean, we didn't even touch it there. It's just another little addition and another little tool. I mean, okay, it used it there. It extended its initial balance by.
Why is there 2 blue lines? One up.
Sorry?
One on the top.
Yeah, one at the top and one at the bottom, because once you've got your initial balance, that's your predicted extension either side of it. When we get into
50% up.
yeah, 50% up and 50% down. When we start talking about day types, which after a coffee we're going to get to, you'll see. You're off.
I'll be back later.
You're coming back from month end, yeah?
Yeah, just got to take my wife to GP.
Alright, good luck,
see you later.
everything's alright. See you later. When we start talking about day types, there are certain day types that, you know, this would be a sort of predicted extended range to. But it's, I'm not even sure if I've got it posted on my Bund. Oh yeah, it is on my Bund. I mean, it completely ignores it in the Bund. It just so happens that I've got it on there. It's not particularly important. The Bund, it ignores it completely. The Eurostoxx, it goes through cycles of working and cycles of not working. Are there any questions from our remote people? Let's just have a look and let's ask. Just wondering, is there a hierarchy in which of these metrics or combination of metrics make stronger support of resistance, or is it always context dependent? There's no. Yeah, I mean, there's no. No, I wouldn't say that. It's very much context dependent. I wouldn't say that. A high. Out of all of them, I would say low volume nodes and single prints are more important than high volume nodes. As I've said, for the simple reason that a high volume node should trade a significant amount of volume. A high volume node is expected to trade a lot of volume, so therefore you've got to be just that little bit more cautious and careful when using it as support and resistance. However, funny enough, and I've got to take myself off screen again, funny enough, the euro, when you look at high volume nodes now, we're kind of skipping ahead a little bit here because this is a different way of monitoring high volume nodes that we are going to get to. But it posts high volume. You can post high volume nodes as an accumulative set of high volume nodes. So just not on the day, but actually, you can have 2 months worth of high volume nodes. The euro specifically tends to actually use high volume nodes as areas of support and resistance. So you can see this green line represents a high volume node, and you can see it's been support here, massive resistance here, back to resistance here, amazing resistance here, and even this high volume node you can see it's used. So as with everything, it's context dependent. It's also market dependent because different markets do have their own characteristics, and so not every market behaves the same. But generically, what I would say is that markets in general, certainly the Bund and the Euro stocks, your single prints, your low volume nodes are more significant than your high volume nodes. Closing gaps are incredibly important, as are naked VPOCs. Out of all of them, I would say the high volume node is the one to be most cautious with, and the rest of them are incredibly important. Basically, anything that's not important and is a waste of time, you're not even going to hear come out of my mouth. Everything that I say is expected to be important. Alright, let's take a break there. We've got so much to get through, and I get the feeling that we might not even finish day types today. Well, actually, where I can see this going is we will finish day types today. We might not get onto economic data, so I don't want to fall too far behind. So let's just take a quick 5, grab a coffee, grab a water, whatever it may be, and then we'll come straight back in here. And I want to go through day types. I'm just going to leave everything running, Nick, so that I'm just going to leave everything running so that you can still be in and out. I forgot that Milan's off today. I must make a mental note for get these videos to him. We file these videos across. Right, I'm going to go grab a coffee and take 5. You off to your masters?
No, I don't have anything.
No, you're off today, are you?
No,
Nice.
I'm just going to stay here for the whole day.
Only chat, only asking.
I know, I'm just, because you said I'm off, so I didn't quite know.
No, I thought, are you off? Are you going to do your masters?
No, hopefully I don't have
You
to.
don't have to today.
Yeah.
Nice.
Until week 6. 其实快都不错。270，妈逼！早上一个大转播买了，反正夜盘就第一笔赔了150，这都已经挣了都是240了，差点没到，然后那个第二就第3笔挣了，4笔。好像第2笔我也是，也涨了好多，结果我他妈是翻了2个 K。我搞出来的。
第一次说我爱你，然后我就给你家挖石头。第二次说我爱你，然后我就给你家。这次说我爱你，是你家收猫名字，然后我还说。
那个担心，那别人他妈不好喝，然后万一他妈没过去。我说他妈没瘾，你还听我说话？因为我有点皮。
So a couple of headlines being picked up suggesting that the Swiss government will be facilitating the accumulation of capital by TBTF banks, and that's too big to fail banks. The Swiss government will ease the tax burden for too big to fail capital. Comments via Twitter from FI Quant amongst others.那跟我俩用人家还没有。今天我回我跟我他多少多少字，然后他说多少字，哦，他让多少字吗？用你的多少字？就是有你的，虽然在那低，我他妈听懂了，整个一傻逼，还在纠结他妈咱俩朋友的纠结，我们2分钟没纠结，我自己的傻逼的意思。因为以前这样子造的，对。 The EU confirming that Italy have asked for more time to sell their 4 rescue banks, and they see good reasons to accept a postponement. So we already knew from yesterday that Italy were looking for an extension on the deadline to sell their 4 rescue banks. The EU here saying there are good reasons to accept that postponement. Swiss government here again reiterated that the tax burden from certain financial instruments should be reduced so that the capital accumulation of too big to fail banks is not adversely affected. We've seen some earlier headlines around this topic. Separately, a German economy ministry spokesperson saying that when asked on Deutsche Bank, German companies in general need strong partners for lending, and German banking sector is well positioned. And this is around Deutsche Bank, fairly vague, but a German economy ministry spokesperson on the topic of Deutsche Bank saying that German companies in general need strong partners for lending, and that the German banking sector is well positioned.
Yeah.
The more from the Swiss government saying that they've instructed the finance ministry to prepare a draft consultation paper on amending the participation deduction in connection with the too big to fail legislation. For more detail around the earlier headlines from the Swiss government.
That'd be really good. That'd be nice. No. Good. We've got bits coming still coming.
German spokesperson saying that Obama and Merkel did not talk about the Deutsche Bank issues in the US.
Happy days. Happier days. See you later, mate. Righty ho. Alright. There's no other way to get round this. This is gonna be a lot. Okay, this is I know over the last couple of days you've taken in a lot. I will back off this afternoon and give you a bit of a breather. This is going to be a lot to take in. Okay, it's carrying on from everything that we're speaking about, everything that we're talking about in terms of market profile, and it's assessing. And we're talking about the type of day that the market's going to or is likely to turn into. There are actually only 6 day types that the trading market will turn into. There are only 6. So before you came into this room and you wanted to assess the market, you would not necessarily have known. You would have thought there were millions of outcomes, millions of possibilities as to where the market's going to go. There are actually only 6. So that's good news. Because once you get this down pat, and once you learn this, and once you can analyse the market as such, then you can start actually feeling confident and trading with the right type of perspective. All of these day types start and create themselves from and around the initial balance. So that initial balance is still so important. So just to recap, the initial balance is the first hour of trading. the K and the L prints if you're trading in the Euro stocks. Or the half 2 to half 3, so the A and the B prints in the S&P. The most basic day structure, now there are pictures here, but they're coming up, so we will go through them. The most basic day structure is a normal day. It's easy to follow and understand, as most of the day's activity is in the initial balance, i.e. the first 60 minutes of the day's session. On a normal day, the bell curve also develops within the range of the initial balance and does not go much beyond the initial balance. There is often limited range extension and the market returns into the initial balance for its close. In actuality, normal days are incredibly rare. Incredibly rare. So we can almost scrub that off our list. It is very unusual to get a market that creates a large enough initial balance that the market stays there for the remainder of the day, with buyers and sellers cutting it off at each extent of the initial balance. You do not often see an initial balance big enough for this day type to occur. So what you would normally be looking for is that large blue line, your large initial balance, and then the market just bell curving around the initial balance. It doesn't happen that often. If we were to go through our charts, and we will do, we should get enough time to do this, but we will go through our charts, I will probably struggle to find one for you. So, that is a normal day. Large initial balance, staying within the initial balance. A normal variation day, or a variation of a normal day. This is the most common of the different day auctions that you see in a market profile. On this day, we will see a range extension outside of the initial balance, and often the market continues its probe on the same side as the break above the initial balance and goes to complete it by extending it to 2 times the initial balance range, some cases 3. So you know, when you were asking me about that little blue line, that's why on some days you get the support and resistance around it in the Euro stocks, but only 2 times the initial balance. If you had an initial balance of 10 ticks, then it would be 10 ticks on top of that, sometimes 20 ticks. So 200% or 300% above your initial balance. On a normal variation day, the first 30 minutes are often spent above or below the previous day's value area, and price seems to suggest a rejection of that value, and then we see value built higher or lower on such days. It is a pointer for continuation in the coming sessions. Usually these days have a lesser sized initial balance, so much more common than a big initial balance, and one side of this initial balance is broken, causing that range extension. The extension is cut off, and then the buyers and sellers continue to auction with a slant to the broken initial balance side. We tend to call these, and we tend to refer to these as P-shaped or B-shaped. And again, I will show you pictures, but it's where you have your initial balance, the market then drives higher, but it doesn't turn into a trend day. it just drives out of initial balance and then it finds value at the top end if we've broken higher, and you get your bell curve, so that shape of a P, or we get the B if we've broken lower and we are ranging at the bottom. You're not expected to remember these. There are pictures coming up to help, and of course, as ever, I would suggest going over them, and of course you've got the book that's going to get hurled at you at some point today for the weekend. A neutral day. A neutral day is again based on the initial balance. We find that the initial balance is slightly smaller than a normal day or a normal variation day. Prices make a move away from this initial balance early in the session, but it is not successful in creating a good range extension. The market then comes back into the initial balance. It travels through the initial balance and then makes an attempt at a range extension on the other side of the initial balance. Accordingly, based on the second attempt of the range extension, you have two types of neutral day. Neutral center. In this type of day, the second attempt of the range extension is also unsuccessful, much like the first one, and the market comes back into the initial balance and closes near the day center or midpoint. On such days, we consider both buyers and sellers as equal in strength, and the close in the middle is fair. So what you will often see, your IB in the middle of the day. So we've pushed lower, didn't like it, come back in, tried to go the other side, didn't like it, and so we bell curve with our initial balance tucked in the middle of the day. They are also fairly common. Neutral centers are fairly common. A neutral extreme. In this type of day, the second attempt of the range extension is successful, and the market finishes the day at one extreme, which is often the day's high or lows, as the case may be. In this type of day, of course, the buyer or the seller is considered stronger than the other, and it gives us context to watch for continuation. So again, when we look at this, you're saying that the first attempt of the break of the initial balance has failed. It's an IB failure, initial balance failure. The market will come back into initial balance, and then you're looking at that point for the other side to go, and it will either extend to give you that neutral extreme where the market is successful in breaking away, or it won't and it will come back into center. The IB, in terms of what you're looking for, tends to be relatively small, not quite as small as when you as on a trend day, but it does tend to have, it's not as wide, of course, as your previous days. So when we were talking about our normal days, we're talking about an incredibly wide initial balance. On our normal variation, has somewhat of a smaller initial balance, but of course by the time we get down to a neutral day, that should have an even smaller initial balance. So the initial balance and the size of it within the first hour of trade is of course a key barometer and a key indicator as to what type of day at the outset we are likely to get. A non-trend day, as it describes, this is characterized by a narrow range with a fat profile. There is a random rotation with little price movement on either side of your profile, thus developing a short, fat profile. These days often occur prior to important announcements, long weekends, or holidays, or at market exhaustion points. Most traders will simply complain that the market is choppy and untradeable on these days. It is when the market is making a narrow range that a large range and possibly trend day will occur in the next day or two. We often see these signified as well when we talk about inside days. So it's when the market is trading within the previous day's range. Okay, it often occurs there. It's often an absolute, as it says, it's a nightmare to try and trade. Most people will sit back and will pretty much bide their time looking for the next day's move. A trend day. A trend day will usually begin with the smallest initial balance. However, early in the day structure, range extension occurs. This range extension does not allow a value area to develop in the initial balance, and the range extension continues throughout the day. These days are seen as having higher highs and higher lows in almost every 30-minute period. So the market on days like this doesn't really ever establish value. It's still seeking value. It might for a very short time adjust its volume point of control, but it hasn't actually found value. Value only occurs when buyers and sellers agree. And so value only really ever occurs when you find more of a balanced day. So when the market is trending, we still haven't found value. So that's why you will normally find that the market will close on its high or will close on its low, because it's just run out of time. It's not actually found value. It's not found anyone to step in and create value. It has just run out of time. Therefore, it will close on its highs or its low. There are often periods of single prints on the profile, as we have discussed. And most important, there is very little rotation from time period to time period. In other words, each half-hour segment drives prices further in the direction of the trend. And you will generally find this, and there's a reason these slides are in this direction, you will generally find this subsequent to some of these day types, these non-trend days, these neutral days, where the market has spent a period of time in balance and then something's changing to shift the balance of the market. Sometimes one of these time segments will have a little bit of rotation in the opposite direction, but prices usually will resume the trend. In such cases, we keep an eye for a pullback high or a pullback low to develop, and we aim to get in line with the trend. We trade on a trend day, you trade in line with the trend. You never, ever, ever fight a trend day. The range of a trend day is wide and the profile is absent. There's no bell curve. Why is there no bell curve? Because there's no value. We are shifting value. Rotations are thin. The open will occur at one end of the trend day and the close will be at the opposite. We will open on our lows, we will close on our highs, or vice versa. A double distribution trend day is slightly different. A double distribution trend day is often inactive to start with and looks as if we are in a balanced day.
Most markets in Europe are open on Monday, with the exception of the German equity markets. German equity will be closed on Monday, and there will be no DAX futures trading on Eurex either. So all the major markets are open, but no German equity, cash equity,
Yeah, it's going to
or
be
DAX
dead on
futures
Monday.
trading on the German holiday.
It starts looking okay. So a variation on the trend day is your double distribution trend day. The day starts off much like a trend day, however, there begins to be a rotation with a bell curve beginning to develop during much of the day. It starts to appear that more of a normal variation day will result, i.e. that P shape or that B shape. It looks as if that's where we're heading, but then new information enters the market. As per yesterday, we saw a good example of this. We'll get all of these charts up so that we re-cement it in our minds. New information enters the market and a range extension occurs and drives prices to a new area. At some point the move is shut off, usually overshooting, and then another bell curve begins to develop. The resulting profile will have two areas of price rotation, which are usually separated by an area of single prints. These days can often occur on surprise announcement or event occurrences. The market goes from balance to imbalance and then back to balance. Okay, so the imbalance is as the news hits the market. But it's not such significant news to turn us into a trend day. It's enough news that it turns us back into a balance day. So they're your day types. That's all they are. 6 day types. Now, looking at this chart here, what I've had to do is, because the normal day is so infrequent, I've actually had to kind of make up my own. Because it actually turned into a different day. But I'm just going to widen this up. But it's this part of the profile that I have circled here. This would have been what was turning into a rare normal day. So we have a large initial balance. It's quite a significant initial balance. It looks like it's from about 50s up to 65s. That's 15 handles for the S&P. That's quite a lot. That's a big move. There's four mini ticks to a fat tick. So of course 15 big ticks, fat ticks, handles, whatever you call them, times by 4 is 60 ticks. That's quite a lot for the S&P. So we had a large initial balance, and then what happened for the most of the day is that we just rotated in that initial balance. That is what would signify a normal day. However, they are so rare that to find it, I've had to I wanted to get a rubber and scrub off the bottom bit, because they're not that often. They don't happen often. But that is what a normal day would look like. Large initial balance, and buyers and sellers cut it off at either end, and we spend the rest of the day rotating in that initial balance. Your variation of a normal day is where I'm talking about getting those B prints and those P prints. There was actually one on the S&P here, so actually we'll go back. This is a very nice P print. So you can see that the market opens down here. It has got a large shift. Slightly lesser initial balance than obviously the normal day. But what we saw is we've moved out. We've had a large range extension. It's then been cut off and we've shifted into balance. It looks really good here. We've opened at our low. We've got our initial balance. We've then shifted out of our initial balance and turned into a slightly P-shaped profile. Now at this point I do want to go to our charts and see if we can find further examples of, because the Eurostoxx is great for this at the minute. Of course, the Eurostoxx is great for this because it's having those large moves on the cash open. So we've got an initial balance here, a very tight initial balance actually. And then we've broken on the cash open. We have aggressively moved lower. So we've got our initial balance. We've then got our aggressive move on one side only of our initial balance. So point in note, this is a shift from one side only. We're not exploring the other side. But then the sellers have got cut off and we have then entered into balance. That is a pure B-shaped profile. One side of the market aggressively tested, aggressively broken, sellers cut off, and then we found balance. It happened a little bit on this day. Wasn't as aggressive a move, but this is also a slight B-shaped profile where we've got our initial balance, we've opened, we've moved out of initial balance, not as aggressively as the other day, but we've shifted only one side, broken one side of initial balance, and then we've balanced off for the rest of the day. Slight P-shaped profile here on the Eurostoxx. Initial balance. We've only broken one side of the initial balance. We've shifted higher, found balance up here. P-shaped profile. And the Eurostoxx is doing this much more at the moment than the Bund. The Bund isn't really doing this at the minute. They seem to be okay. There's not quite, but a similar type of pattern. Only one side of our initial balance has broken. Only one side has gone lower. A slight B-shaped profile. So there's some very real time, very real moments, examples of what we're looking for at the minute in terms of our variation of a normal day. So 2 days so far that we've been through. One is incredibly rare, our normal day. Variation of a normal day, slightly less rare. You know, we tend to get those, we tend to see them.
How would you actually then go about trading when you've got those profiles, the B and the P profiles?
Well, once you've established that the market is shifting out of value, so again we would see it in terms of, if we go back to our Eurostoxx, let's say on this day here, well, we're unlikely to catch this move here. We're unlikely to catch, because at this point we're not going to know. At this point, when we're breaking one side here, it could still be a lot of things. This could be, you know, an initial balance failure could happen, and we could go back to the upside. So one of the other days that we're going to come to, a neutral day, where we're forever sort of breaking either side of the initial balance and the initial balance ends up in the middle. At this point of day, we're not going to know this. However, when we have established and we see that the market is building here, we then know that the market is unlikely to break any further, so we're going to be a buyer at value area lows and we're going to continue to be a seller at value area highs. So we're just going to keep trading in this B, because we know that we've now got a higher probability that the market is going to stay within that range. And you're only going to really have established this maybe at 10:30, 11 o'clock. But that still gives you 5 hours of the trading day, where at least you're not going to be selling the low, thinking that we might turn into another day, or buying the high, thinking that we're going to come back up here. So you would have established, with 5 hours of the trading day left, that we are likely to remain in a B-shaped profile. A trend day. Okay, a trend day, as we have said, is a day, a standard trend day is a high level of confidence a high level that the market is going to continue in one direction. We tend not to get, as per here, you tend not to get any statistical bell curve, you don't get any acceptance of value, you don't get any clean distribution. The market is just continually moving higher and higher and higher, or lower and lower and lower, and every time print, you know, would of course replicate that. Now of course in the Bund we've had some great trend days over the last few days. So if we look at the 22nd, which is not that long ago, actually no, the 22nd was more of a double distribution. What would have been a great trend day? Okay, here is a slight example of a trend day, because the market has never really made any sort of bell curve. We've just moved higher and higher from this initial balance break, and we have just shifted up and up and up the page without ever really accepting any form of fair value. In this case, this is actually a neutral day turned into a trend day. So some of these markets do obviously change day type throughout, but in terms of this example, you would normally be expecting the low to be within a few ticks, or the open to be within a few ticks of the low, and the market just continually auctions higher and higher with very little overlap, very little pattern on the volume, very little pattern on the profile, and finish its day near its highs. Okay, it would be that sort of trend that you're looking for. So in terms of maybe the Eurostoxx has got a good example. So here is a good example of a trend day. We've opened fairly near our lows. Our initial balance is reasonably tight, and then the market has just moved up without any real form or shape to it until we've got up here and ended up settling in more of a balance. A pure trend day, again, that's got enough. Again, you know, some of these days they do go from one to another. So here is a pure trend day where the market's opened pretty near its highs. Top of the initial balance hasn't been broken at all, and then very, very little structure the whole way down. Even towards the end, where we thought maybe it's running out and turning into a P, it's kind of travelled even lower. So that is, you know, a purer trend day to the downside. What we do happen to see a bit more often than a pure trend day is a double distribution day, both in terms of volume and in terms of profile. The market looks as if it's developing and turning into a balance, but then something happens, we shift out of balance, and then we find new balance. You can also get triple distribution trend days. So in terms of some of these areas here, this in a sense was a triple distribution day. So we were in balance here, we then shifted lower and found a bit of balance here, and then of course we shifted even lower and found balance here. A double distribution trend day, the Bund had one. Across here, we thought we'd found balance, and eventually we broke higher and ended up with more of a double distribution day. This is a really great example of a double distribution day. Just a few days before that, where we'd had what we thought was going to be a P-shaped profile, and then of course the market broke higher and we ended up with a double distribution day. So although it sounds great at the beginning of the day that we can identify what it's going to be and off we go and whoopity-doo, of course the problem is, and the caveat is, that what is beginning to be a trend day, or what is beginning to turn into a day type, can shift. And part of the skill is recognising when the market is going to shift from one day type to another. And that takes a varying degree of skill. Okay, so on this day, you would have spent the whole day thinking that we are going to be building a P-shaped profile, and then of course something happened, we broke higher and we shifted into a double distribution day. What is unlikely to happen is you're unlikely to find a market shift from balance to trend. Okay, so you can limit some of your confusion and some of your worries in that if a market is finding balance, like here, even though it shifts, it is more probable that it's going to turn into a double distribution day than a trend day. Trend days tend to get set and tend to happen from the open to the close. It is also unlikely that a trend day is going to turn into a balance day. So at least some of the crossovers, when they do happen, are a little bit more manageable. So if a market is in a B or a P-shaped profile, it has got the potential to turn into a double distribution or a triple distribution, but it is unlikely to turn into a trend day. Okay, trend days are usually set very, very much at the open. A non-trend day, otherwise known as a boring day. It's a day where, as we have said, buyers and sellers are pushing on either side of our initial balance and are just getting cut off. The initial balance then tends to auction around its initial balance, and then the initial balance tends to reside in the middle. A non-trend day is a fairly common type of day. A non-trend day is more common than most, as you will see from some of our charts, particularly our Euro stocks. At the minute, aside from these days where obviously we've had our initial balances at highs and lows, this is fairly common. This is a pure non-trend day where we've got a medium-sized initial balance, and because it's a medium-sized initial balance, notice the difference in size. Visually you can see, just visually, these are smaller, these turn into something else. Smaller initial balance is much more likely to turn into a P or a B shape, so a variation of a normal day, or a trend day, or a double distribution day, whereas when you get this sized initial balance, it's much more likely to turn into one of the harder days to trade, one of the most horrible days to trade, in that it's a non-trend day. Okay, it's not a normal day because the initial balance isn't wide enough and our activity hasn't been contained entirely to the initial balance. But what's happened is we've probed. We've tried to get higher, we haven't. We've come back in. We've tried to get lower, we haven't. We've come back in. The buyers, and when we go back to the slide, if you recall, neutral day. In this day type, we break, we find the initial balance is slightly smaller. Price moves away early in the session but is not successful in maintaining it. Comes back into initial balance. It then travels through the other side of the initial balance in an attempt to range extend to the other side. It will then either do one of two things: turn into neutral centre, in that it fails the second attempt and so it's just a non-trend day, or it will develop into something else. So in this example here, awful day. We failed to go to the upside, we've come back in. We failed to go to the downside, we've come back in. We balance. IB tends to sit somewhere in the middle. You know, never exactly, of course, but somewhere in the middle.
And on days like that, you're unlikely to trade?
Days like that, you go to the gym. You're happy if you don't lose money. You're happy. Yeah. I mean, they do, you know, they are tradable. Of course they're tradable, because you could, in theory, just buy or sell, you know, either side of initial balance, but they're hard. They're much harder. Fortunately, there don't seem to be that many. Some of these IBs are a bit tight, but again, these 2 days in particular, you know, they've failed. Even with a tight initial balance, that's a very, very difficult day to trade, because of course a lot of people with the tight initial balance are going to initially be thinking, okay, we're on for a trend day or a P or a B, and of course it ends up being a neutral day. Again, a neutral day tucked in here. So there is an art form around the science. It's never as easy as it says on paper. I'm always very, very keen to tell people that, you know, there is an art around the science of it, but that would be a very difficult non-trend day. Again, a neutral day, very, very similar to a non-trend day, marked by that probe either side of the initial balance, and we're failing to escape on either side of the initial balance. Now, in terms of our conviction rate, of course, naturally, and this is the market conviction rate and should of course be your conviction rate, on a non-trend day, the market has no conviction whatsoever. The market has no conviction to move one way or the other. And as we run through the days, right up until the ultra trend day, the ultra trend day is the most convicted trading day. Double distribution, well, triple distribution being slightly under that, double distribution being under that, of course, all the way down to P and B shaped to neutral days. So the market's conviction rate should always be in line with your conviction rate as well. That's why, as your conviction weakens on a trend day, it's much harder for you to trade. And when the market's convicted in direction, it's much easier for you to trade because you have a higher degree of conviction as well. So of course they go hand in hand. Yes?
Points for the double distribution. Will the initial balance
Will the initial balance,
should be?
where should it be? It would usually be in the first part of the bell curve. So in the first part of that supply and demand on a double distribution day is where, so here, this was a triple distribution day yesterday. So it would usually be at one extreme because the market has started off the day as something else. So the market has started its day actually as a neutral day or a non-trend day. So you see what's happened here is we've got a reasonably tight initial balance. The market's probed higher and failed. It's then probed lower and failed. So at this point, around this price point here, so let's split it up at the Y's. Of course, coming into yesterday, this is all you can see. This is all you can see at this point in time yesterday. Never underestimate how easy hindsight makes this stuff look. Okay, so at this point yesterday, of course, this looks like a neutral day, a non-trend day. It's just had probes either side of the initial balance, and you're actually thinking, my God, this is an awful day to trade. But of course, it turned into something else because there were announcements and there was news. And so as soon as something happened and the market started shifting, it was always going to turn into either a double distribution, a triple distribution, or a trend day. So only ever really three options. But your initial balance on these days would always be, they would always be within the first part of the bell curve. So they're always likely to be somewhere to the centre of that first bell curve. So if we try and find another double distribution day, well, that was kind of a triple distribution day. It never really found balance in the morning. In fact, that was never a double distribution. That was a P-shaped profile, or a B-shaped profile, that then turned into a triple distribution. So it was only ever going to do one of two things as it started breaking lower. It was only ever going to turn into double distribution or triple distribution. So you see how if you created a little spreadsheet for yourself, once you've got one type of profile that's building, there's only a limited amount of things it can turn into. It was never going to turn into a balance day. It was never going to turn into a trend day. So you're cutting your options down, your probabilities. You're placing probability on your side. So with these double distribution or triple distribution days, your initial balance would sit within the first part of the bell curve. So here we've turned into a triple distribution. So your initial balance has fallen within the first part of the bell curve, and at this point, until the Z prints, maybe there was a figure, probably some sort of news event, until the figure came out, we were having a non-trend day, a neutral day, a market that was probing either side of the initial balance with no conviction to go anywhere. Now, of course, because we had found balance, it was never going to turn into a trend day. Only one of two things on that day could happen: triple distribution or double distribution. Can't turn into a trend day because it's already found balance. A trend day has to have started at the beginning of the day. You know a trend day, the low's at the extreme, and we've shifted quickly. And we're never finding balance, we're always shifting value. This is a market that is finding balance, but then it's changing its balance. So again, a trend day can't ever turn into anything else. Trend day can't then become a balance day. A trend day from start to finish is a trend day. Okay? I'm not expecting us to all be experts today. You will be experts. You will be experts. But as long as every session we're moving closer, then that's really good progress. So are we happy for now? Excellent. All right, good. Well, that's exactly where I wanted us to be. That is our key market metrics and our day types done. What that means is that later this afternoon, I can issue you with the wonderful book that is Mind Over Markets. I also want to go through the monthly diary and some of the figures that are out so that we can prep ourselves coming into next week when we have to start talking about macroeconomics. And because it is month end, we will do a slight switch, and I will talk to you, and I talk to everyone on the stream anyway. We will talk about month ends, and then there's a great video for you to watch, and I will be here till later trading month end as well. So yeah, we're exactly where we need to be. So that gives us time for lunch, gives me time to go to the gym. I will speak to everyone on the stream at 1 o'clock, and then we will crack on with our monthly trading diaries. Cool, well done. I think I'm going to do a cycle today. Go for a cycle.
You should cycle into work.
40 odd miles, 45 miles.
Where are you based at?